Hello and welcome as we continue our Business Management Unit 7, talking about business finance in this unit. In today's lesson, this is lesson 7.4, we're going to be talking about capital investments. So the objectives for this lesson are to analyze the advantages and disadvantages of capital investments and propose potential consequences of investment decisions. Also to evaluate and determine potential investment options for a sample business scenario. So let's get right into it. So capital investments are the purchase and implementation of assets by a company to increase their profits or fulfill long-time production goals. Now, there are some key types of capital assets, what are called capital assets. They include physical, which is like buildings, land, machinery. There's technology, which is softwares and computers. There's infrastructure like office equipment and furniture, and there's human capital, which is like training programs. So like a real world example of a capital investment is Tesla's billion gigafactory investment for their electric vehicle production. Now, some advantages to capital investments. There's a cost savings over time because you reduce your operational expenses. As an example, in the Amazon warehouses, they use robotics. They invested in robotics to help be able to add improved efficiency and so increase the production output as well as having faster processing times. It also allows you a streamlined process, like a better workflow management and enhanced coordination. And of course, it can cause a competitive advantage because you get superior product quality and there's a market differentiation. So when you are investing in capital, there's like an analysis, a decision analysis that you're going to make when you're making this investment. So some key considerations to this is the initial cost versus the long-term benefits. What's the market demand? Is there a technology relevance to this investment? What is your ROI or your return on investment timeline? You also have to assess some of your risks like market changes, technology obsolescence. Is the technology becoming obsolete, out of date? There's economic fluctuations that can also go into that risk analysis. But when you're talking about these investment decisions, here's a real world example. Microsoft invested $1 billion into OpenAI, which is, of course, the creator of ChatGPT. They made this partnership. Microsoft obviously believed that there was some of these benefits in partnering with OpenAI. You also have to take a look at potential consequences and mitigation when it comes to capital investments. You have to look at the unintended consequences. Is the technology going to become obsolete before your return on investment, your ROI, is achieved? Are there going to be market shifts that affect the investment value? Are there maintenance costs that exceed the projections that you made? So some strategies that you can use to mitigate or balance out those consequences are thorough market research, a phased implementation where you do it in stages, regular assessment and adaptation, making sure that everything is working properly. You're assessing what the investment is bringing and adapting where needed. And then, of course, looking at any contingencies and try to plan for those. So that is our lesson 7.4 on capital investments. The objectives were to analyze the advantages and disadvantages of capital investments and propose potential consequences of those investment decisions, as well as kind of looking at evaluating and determining potential investment options in a business scenario.